Hi friends, welcome to Fin Ideas. Investment के ideas means Fin Ideas. Let's understand the smart wealth creation ideas for US market. How equity plus safety can make prosperity that we are going to understand today. So the main objective of this presentation is to understand how long-term investment can be done in index. How we can get safety against market fall. Do we understand the concept called equity plus safety makes prosperity? Then we will understand the benefit of leverage, and finally we will understand index long term strategy. We are from Fin Ideas. Investment के ideas मतलब Fin Ideas. We are SEBI registered investment advisor, and the disclaimer is that equity investments are subject to market risk. Kindly consult your financial advisor before having any kind of investments. Friends, Fin Ideas is dealing with more than 75 members of exchange. We are 26th company in India to register our algorithms at exchange, and we have trained more than 60,000 traders and investors till now. The mission of Fin Ideas is providing transparent solution to everyone for achieving financial freedom. And we are having our presence in 7 countries as of now and 21 cities in India. Till now we have completed more than 400 plus webinars. More than 60,000 plus people have registered, 33,000 plus people have participated, and around 540 crore AUA we are managing as of now in index long term strategy. So what exactly the index long term strategy? Let's understand this. How we can generate low risk and high returns. So friends, we start this presentation with the example of properties. People invest money in properties because they are getting two confidence out of that. The confidence number one, that is property cannot become zero, and second benefit of property is that if I can hold it, sooner or later I get the appreciation. But when we invest money in direct equities, we don't get this kind of confidence. If our view goes wrong and if we select some wrong stocks, then our money can become zero also in direct equities. So in equities we are having high risk as well as high return profile. But our target was not to take this kind of high risk. So we took two decisions over here. Decision number one, that we are not going to trade in individual equities. So no Apple, no Alphabet, nothing direct shares. So where are we going to invest money? We will invest money in index. And that index as of now for US market is Nasdaq. So what exactly the Nasdaq is? Nasdaq is the average of top 100 stocks of country. As of now we are having Apple, Microsoft, Amazon in that Nasdaq index. But before some time we were having some other stocks also over there. As soon as their valuation has fallen down, it reached to 101. Automatically those stocks moved out and some new stocks came in. What does it mean? It means that if the index is the average of top 100 stocks of the country, it provides us the confidence number one that it cannot become zero. So index cannot become zero. It may fall down, it may go up, but it can't become zero. Secondly, before some time, the market capitalization of Apple was around 1400 billion. Microsoft valuation was around 1300 billion. If I sum up the top 100 stocks valuation, it was around 15 trillion. And that this 15 trillion was equal to 14,000 index level of Nasdaq. What does it mean? It means that when the price of stock moves up, the valuation will go up, this total will go up, and simultaneously the index will rise. And the same rule is applicable when market is falling down also. Now my question is that if today the richest company of US market is having the valuation of around 1400 billion, then after 5, 10, 20 years, whoever will become the superpower of US market, that company should have the valuation above 1400 billion. If that will be above 1400 billion, the top 100 stocks at that time will jointly have the valuation above 15 trillion, and automatically the index will be above 14,000. What does it mean? It means that whatever confidence we have got from the properties, that property can't become zero, sooner or later it rises, both the confidence we are getting from the index of that country. Because index is the average of top 100 stocks of the country, it cannot become zero. And because it is directly related with the market capitalization, so sooner or later it rises. So now let us understand the concept called equity plus safety makes prosperity. So the question comes, can we get safety against equity? So the answer is yes. How? Let's see that. So earlier we were trading directly in equity that was having high risk. We were interested to take low risk. So we converted ourselves from direct equity to index. Finally, our target was equity plus safety makes prosperity. For that, what exactly we do? First, we will buy the Nasdaq index. Suppose the index price is 10,000 as of now, just for an example. So I will invest 10,000, I will get the delivery of index. Simultaneously, I will buy its safety, that is called put option. Looking at past 9-10 years experience, annual put option cost us around 8% a year. So against 10,000 index value, I need to invest $800 more for the protection. So for others, the cost of index comes around 10,000. But for us, the cost will be 10,800. But this 800 rupee extra has given us the confidence that in any case, if market will fall down, my 10,000 is going to remain protected. So this is the great feature, that on downside I am having limited risk only, and on upside I am having unlimited profits. So there must be some side effect also of this feature. The side effect is that because of any reason, if market remains at the same level for a year, then whatever amount I have paid for the protection, this is 800, that I am going to lose. So the good point is, suppose you are investing $100,000. So in full 1 year, in any situation, your 100,000 cannot go below 92,000 in any case. Now let's understand the worst case scenario. Suppose you have invested in 2023 at 10,000 index level. After 4 years, 2027 has come, but still your index has remained same level of 10,000 only. Ultimately, this is stock market, so anything can happen. So if market remains at the same level for 4 years, then whatever amount you have paid for the protection, that you are going to lose. Suppose you have made the portfolio of $100,000. In between 2024, 25, 26, market has gone up from 10,000 to 12,000. But again it has fallen down next year. Again it has recovered and fallen down. You have made the portfolio of 100,000. So definitely you will like to protect it. So you will add 8,000 more to protect this portfolio. Next year market has gone up from 10,000 to 12,000. So index has gone up by 20%. The question comes, what will be the value of your $100,000 portfolio? So it will reach to 120,000. You are going to earn $12,000 only, because 8,000 you have paid against the protection. Next year you would like to protect the portfolio of 120,000. So you need to pay more premium. Now you need to invest 9,600 for next year protection. Next year market has fallen down from 12,000 to 8,000. So index has fallen down by 33%. But your portfolio of 120,000 will remain same up to 120,000 only. The question may come that when market falls down from 12,000 to 8,000, logically your 120,000 portfolio will become 80,000. That is correct. But whatever amount you have lost, that is $40,000, that you will get back from this put option. The beauty of this strategy is that whenever market falls down, you get the claim. What you are going to do out of that 40,000? You will reinvest that 40,000 again at 8,000 level. So your number of shares will rise and your portfolio valuation will remain same to 120,000 only. That is 80,000 earlier one plus 40,000 new portfolio. Again you have paid the protection premium. Next year market has recovered. It has again reached to the earlier level of 12,000. But for us, when market moves from 8,000 to 12,000, it has gone up by 50%. So your 120,000 portfolio will become 180,000. Again you have paid the premium. Next year market has fallen down. But now you have already understood that when market will fall down, you will not fall down. Rather, your number of shares will rise. So what exactly the learning is? In 4 years, market remained at the same level from 10,000 to 10,000 only. But your portfolio of 100,000 has become 180,000 because of these protection. You have paid this protection premium also. You should consider this 8,000 plus 9,600 plus 9,600 plus 14,400. So net you are not going to earn 180. Rather you will receive around 140,000. But the learning is that in 4 years market remained same, but still you are growing. Mr. Warren Buffett, 92 years age, he had made billions of dollars in stock market, and he is summarizing his investment wisdom in just 2 lines. There are only 2 rules of investment. Rule number 1, never lose money. And rule number 2, never forget rule number 1. What exactly this learning for us? The learning for us is that this is our responsibility to protect our wealth. If we can protect it, sooner or later definitely we can grow it. So now let's understand how practically we can use this idea. So suppose you want to make the exposure of 100,000. What you need to do? Invest 50,000 only. So that means 50,000 amount you have invested. You will buy the index ETF first from this $50,000. So now you have got the delivery of $50,000 ETF in your Demat account. Put them as collateral in derivatives market. So the question comes, what exactly the collateral is? So when we trade in futures and options market, we need to put the margin over there. We can put the stocks as well as check over there. So when you put these ETF as margin, it is called that you have kept as a collateral over there. Now from this collateral margin, you will buy the index futures of 50,000. So ultimately you have created the portfolio of 100,000. So your target of creating the exposure of 100,000 has become possible by investing 50,000 only. If market will rise, you will earn on 100,000. If market will fall down, you will lose on 100,000. But you don't want to lose on this 100,000, so immediately you will keep hedging over there. By paying this 7.5 or 8% premium, now your complete portfolio is protected. So you have invested first cost of 7,500 against the portfolio of 100,000. One more cost you need to pay, that is called financing cost. Why financing? Because you have invested 50,000 only. You have bought the futures of 50,000. So when you buy the future, every month you have to roll it over. So this is called future forwarding cost, future rollover cost. It is around 0.5% a year. So that means for 50,000 multiplied by 0.5%, around $250 you need to pay against financing cost. So your total net cost is 7,750. So if market will fall down, this may become your maximum risk. But if market goes up, you are going to earn on full 100,000 portfolio. The question comes, what exactly had happened who have invested money in past? Let's see on the real data. Here we have kept on the first column the calendar last day of the year since last 20 years. The second column is giving you the index level on that day. The third column is showing you the investment of 50,000 against the portfolio of 100,000. The fourth column is showing you the strategy return. So your 50,000 has become around 500,000 in 20 years. So 10 times in 20 years. How it has become possible? The reason is simple. When market moves up, you also earn money. Market has gone up by 49%, you will earn by 80% because you have made the double valuation portfolio. So sometime it is going to happen that market will not perform. At the time you are going to lose money of hedging and financing cost. But overall, if you see in long run, you have outperformed the complete level with safety. So in last 20 years, you have generated the ROI, that is CAGR of 12% on your investment. What exactly the minimum investment is? So the minimum exposure is $100,000. For that you need to invest initially $50,000 only. What is the fee of FinIdeas? FinIdeas is charging you a very nominal fee against this advisory. If you make the portfolio of around 100,000, your fee is 0.75 paisa, that is 0.75% for 6 months. When your portfolio moves above 100,000 to 1 million, the fee will further reduce to 62 paisa, and when your portfolio reaches to 1 million and above, your fee will further reduce to 0.5% only for 6 month period. So till now what did we learn? We understood that this is the combination of equity plus futures. Why equity? Because we want growth. Why futures? Because we are getting low cost funding out of this. We are keeping our risk downside limited. We are managing complete fund flow smartly. We are investing money in index only because index provides us the confidence that it cannot become zero, sooner or later it rises. We are having low risk profile over there. The past track record is very strong. We have the complete infrastructure about this so that you can get all the reports on just click of button. There is no lock-in period. Whenever you want to enter, you can enter. Whenever you want to exit, you can exit. But still, we recommend to have logical period of investment of around 5 to 10 years for this strategy. We are having dedicated team with us. They will help you step by step. We have the algorithms so that you can get advisory through technology. People can plan their retirement, kids' higher education, kids' wedding from all these investments. And the great point is all the trades are going to happen in your own account. So your money is going to remain with you only. So if you have the interest in this strategy, you will get the link in the comment box. You can click on the link and can register yourself. So after that registration, our team will ask you to complete your KYC, that is know your client process. It's a very simple online process. Our team will help you in that. If you are happy with the presentation, please write your review also over there. You can comment us, you can ask your questions also. You can subscribe to our YouTube channel, our Telegram channel. And if you have further queries, feel free to get in touch with us.